Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. All right, US stocks once again stuck to that 4150 level yesterday, but as expiry approaches and Tesla earnings overnight disappointed with the stock down about 6%, we have managed to slip back lower towards 4120.25. And also as you move away from those big strikes around 4150 and 4200, because the delta is diminishing, because the gamma is diminishing, the strength of that pin does go away. So we're probably at this kind of tipping point where if we break a little bit lower, below say 41.15, 10, something like that, then all that gamma is kind of gone, and there may no longer be much of a pin holding the market up, right? So we're probably at a little point of fragility here. We either need to pop back into that range pretty sharpish on the open, or the market could see some weakness. And we've seen similar sort of dynamics in previous expiries where the street was clearly long, but there was enough pressure building on the market that in the last day or so, we got away from it, and then the pin couldn't hold into the actual expiry day. So don't be surprised if we see something similar to that. Commodities were weak broadly, with energy worst hit, oil down 2, nat gas down 5. We did see gold down a reasonable amount as well, but it did manage to recover off its lows by about 1%. Vols was softer again. We saw a VIX expiry print that was pretty much the lows that we'd seen, around 1675, that thing printed on the open. Vols did start to recover from that low print, but that was pretty brutal, that one. We do see some decent value in upside gamma, as we mentioned in yesterday's video, particularly on things like NASDAQ, which we think the vol will hold up quite well if the NASDAQ rallies into earnings next week with all those big mega caps. Commodity vols were mainly unchanged except for energy, which saw oil bid and nat gas offered. We're still not seeing any real change in the carry profile. If anything, carry is probably getting better in most places. We see these green bars are actually growing. We're seeing quite positive carry across a lot of names. Still got China and nat gas though in negative, but you look at some of these numbers, well over 30% is basically saying, you don't necessarily want to rush out and start paying loads of time decay, given how things are moving around. Now, if you do believe, though, that the reason why Realize has been so low is due to this large, long gamma overhang, and that is going to expire this week, then that maybe gives us a reason why Realize vol should kind of mean revert a bit higher as we go into the next couple of weeks. Skew continues to firm up a little bit in US indices, as some opportunistic put buying comes back. Oil and uranium skew also bid, and nat gas offered, spot chopping around there, not making new lows, and so that skew is coming off the highs. Okay, looking at the charts, what do we see? Debt ceiling issues might come early. Okay, so we've obviously seen a brutal sell-off in volatility over the last few weeks. Investors are kind of now searching for the next catalyst. Is there going to be something that gets this market moving again? FOMC on the 3rd of May is not really being priced as a major market mover. We've got an 83% probability that the Fed's going to hike for the last time, and it's the end of the cycle. If that's confirmed, maybe that's supportive for risk, but it's certainly not going to shock the market because that's already what they're expecting. So what's going to make the market move, right? One story that's starting to emerge is this US debt ceiling deadline. We thought that was going to be in late summer, around August, September time, but now that might be brought forward, as Goldman's point out, due to lower tax receipts in April. It's also something Luke Groman's been talking about, probably before Goldman's work. If this does happen, Congress may be forced to settle the issue sooner than first thought, and the Republicans are playing hardball, asking for $4.5 trillion in spending cuts, which is unlikely to be agreed. So markets might get nervous of a government shutdown. Shutdowns have happened before, so past occurrences, there's always been resolved eventually, even if it's gone into a temporary shutdown, which just means they pay their bills they find ways to pay their bills somehow. But generally, there's political theater. They wait until the last minute to really solve all this stuff. So I'm not expecting some major market crash or anything like that, but we might get some noise around it. We might get a bit of an uptick in vol as people get nervous around it. So these are the type of things to look out for. The TGA account has also been drawn down pretty aggressively. Obviously, we've seen that. That's why net liquidity had turned up. As you saw this big move down in the TGA, that's reaching close to zero. It can't go negative. So, we are expecting a bounce in the TGA, and we are expecting net liquidity to turn south. So these are the type of things that can get the market nervous and can get things moving again. Overall, we are not calling for a massive vol spike. as these are all known issues that are being flagged, quite clearly by the market. So people know about them, but it's just a question of them becoming more to the forefront of people's minds. So we don't think the risk reward of being short vol is very good. Okay. Now, if we move over to credit, so credit crunch is coming and spreads look too tight. So, we know that credit conditions for small businesses have tightened pretty significantly since the SVB collapse. The magnitude of this tightening can be seen in this white line on the top chart. This is the NFIB credit availability index that has dropped sharply. And this history goes back to the 80s, right? So it's a very long-term chart. Now, typically, when you get these big knee jerks lower in this credit availability, they tend to come with spikes in credit spreads. And we can see option adjusted spreads here, should be more going into the 7 to 10% region when you see these sharp drawdowns in this credit availability. This time around, we've seen a big drop in this thing, but credit spreads are still at around 4.5. Okay, so something doesn't look quite right here, and spreads do look quite tight, I would say. Okay, so our way of getting exposure to that is through HYG, because that's kind of the most liquid proxy that we've got for credit markets, really, that we can trade options on. And if we compare, the price action of S&P to HYG since that SVB collapse, they've kind of moved hand in hand. But recently, we've seen credit turning back south again, and we've seen stocks holding up. Now, it may well be that stocks are holding up because of this pinning effect, and stocks are just going to catch down again. But in general, we think stocks have a tendency to be more resilient. I mean, I traded through the credit crisis of 2008, and the credit market was blowing up in 2007, but equity markets stayed pretty resilient all the way through most of 2008, and only really caught up in like September, October of 2008, right? So you can have a period where credit continues to deteriorate and equities continues to stay up there in cloud cuckoo land for a little while. And that's something that we need to be aware of. So for me, owning downside in HYG is probably a safer play to start putting on bearish bets than start buying equity puts right now. If we look at the vol dashboard, we can see that vol is pretty cheap, right? We are seeing, but it's generally because spot's already had a bit of a pullback and it's not that to the upside right now. It's saying buying straddles maybe might make sense as well. Now, for our perspective, we're looking for a more bearish stance here in terms of credit because of the fundamental view there. So we're looking at puts. And also a nice thing about buying puts is that the skew has completely collapsed from the highs, right? So obviously the highs in skew at 7, the lows in skew are closer to 2. And that's kind of where we're sitting right now in skew. Also looking at the term structure, it's a very flat term structure, pretty much a flat line at around 8 vol. So that means that we can buy longer dated puts in that kind of September area and not pay a vol premium for them, right? Obviously, if the curve was in contango, you had the front at 8 and the back at 10, you'd be paying an extra 2 vols to buy those longer dated options. That's really not the case right now. So that means the longer dated stuff is looking more attractive. So that's where we land. Okay, that's the idea for today. Thanks again, everyone, for listening, and I will catch you guys tomorrow. Cheers.